Hey, welcome back. Before we start today's lesson, let's take 30 seconds to recap. Last lesson covered 3 key things. First, the rule of 72. 72 divided by your annual return equals the years it takes to double your money. For example, an ETF returning 8% doubles in 9 years. Second, time is the real star of compound interest. Same $200 a month, same 8% return, but the person who starts at age 25 ends up with $363,000 more than the person who starts at age 35. The only difference is those 10 extra years. Third, 3 actions to start the compound machine: start today, automate deposits, and reinvest dividends. Okay, so now you know why to start early. But you might still have one question left: start today, sure. But what should I actually buy? The answer is just 3 letters. ETF. Welcome to Lesson 5, what is an ETF, and why every beginner should start here. ETF stands for Exchange Traded Fund. It sounds abstract, but it's literally just a basket holding a bunch of stocks. You buy one basket, and you instantly own everything inside it. By the end of today, you'll know what an ETF really is, how it differs from individual stocks and mutual funds, why almost every personal finance book recommends it as your first investment, and exactly how to buy your first ETF. Let me start with what an ETF really is. Imagine you walk into a fruit store, and the owner says, picking your own fruit is too much trouble. I packed 5 kinds together, one basket, just $5. You pay once, and you take home all 5 fruits. An ETF works exactly the same way. ETFs have 3 key features. First, it's a basket of stocks. When you buy one share of an ETF, behind the scenes you instantly own dozens, hundreds, or even thousands of companies. Second, it tracks a specific index. The index can be the largest 50 companies in Taiwan, the S&P 500 in the US, global tech stocks, anything. When the index changes, the ETF automatically adjusts its holdings. Third, it trades on the stock market just like a regular stock. Open your broker app, type the ticker, hit buy. It's exactly as simple as buying any other stock. Let me give you America's most famous beginner ETF as an example, VTI. For about $280 today, you can buy one share of VTI. And behind that one share, you instantly own around 4,000 US companies. Apple, Microsoft, Amazon, Google, JP Morgan, and the weights are already balanced for you by the index. So in short, buying one ETF means owning a whole basket of companies. You might be wondering, how is an ETF different from individual stocks or mutual funds? Let me show you a side-by-side comparison. Category 1, Risk Diversification. If you buy a single stock, and that one company hits trouble, your money takes a huge hit. That's concentration risk. Mutual funds and ETFs both hold a basket of companies, so a single company crashing won't sink the whole thing. These two are tied. Category 2, Fees. Buying individual stocks has no holding cost, only trading commissions. Mutual funds typically have expense ratios between 1.5 and 2.5%, charged whether you're up or down. ETFs charge way less, usually between 0.03 and 0.5%. We'll look at real numbers in a moment, and the gap will shock you. Category 3, Trading Flexibility. Stocks and ETFs trade in real time during market hours. Mutual funds only settle after market close, at the day's net asset value. Way less flexible. Category 4, Transparency. ETFs publish their holdings every single day. You can see exactly what you own, all the time. Mutual funds usually report only once a month. What they did in between, you have no idea. Did you catch that? ETFs combine the convenience of individual stocks with the diversification of mutual funds, but with lower fees and higher transparency. So why do almost every personal finance book, every finance YouTuber, even Warren Buffett, tell beginners to start with an ETF? 5 concrete reasons. First, instant diversification. One share of VTI equals about 4,000 US companies. One share of VT equals around 9,500 stocks worldwide. A single company going bankrupt barely moves the needle. Second, low fees. ETF expense ratios are typically 1/5 of mutual fund fees. That 1.2% gap, compounded over 30 years, can mean hundreds of thousands of dollars. I'll show you the exact numbers next. Third, no individual stock research needed. You don't have to read financial reports, follow daily news, or guess which company will rally tomorrow. The index automatically picks good companies for you, poor performers get kicked out, new winners get added in. Fourth, daily transparency. The companies inside your ETF and the weight of each get published every day. Unlike funds where you see one report a month and have no idea what happened in between. Fifth, no fear of any single stock collapsing. Even if the largest holding hits trouble, the ETF will dip temporarily but won't go to zero. But if you bought a single stock, like Lehman Brothers, your principal could go straight to zero. Diversified, low fee, no research, transparent, no zero-out risk. That's why every personal finance book starts with ETFs. I just said a 1.2% fee gap can mean hundreds of thousands over 30 years. That's not an exaggeration. Let me show you the numbers directly. Suppose today you have $100,000 principal, you leave it for 30 years, with an 8% annual market return. We'll compare 3 scenarios. Scenario 1, 0 fees. The theoretical best case. After 30 years, your money grows to $1,006,000. 10 times. Scenario 2, buy an ETF. With a 0.3% expense ratio, your real annual return becomes 7.7%. After 30 years, $932,000. Scenario 3, buy a mutual fund. With a 1.5% expense ratio, your real annual return drops to 6.5%. After 30 years, just $660,000. The gap between ETF and fund is 932 minus 660, which equals $272,000. Same principal, same time, same 8% market return. Just by changing the tool, you walk away with $272,000 more. The 1.5% fee on a mutual fund gets charged whether the market is up or down. When the market is crashing and you're already in pain, that fee still gets pulled. There's a saying in long-term investing, fees are the silent killer. They look painless every year. Stretched over decades, they add up to hundreds of thousands of dollars. Now that you know ETFs are great, the next question is, how do I pick a good one? I'll give you 4 key indicators. Check them in this order, and you're set. First, what index does it track? ETFs come in 2 big categories, broad market and thematic. Broad market ETFs track the entire market, like VTI, VOO, or the S&P 500. Beginners should pick this kind. Thematic ETFs track a specific sector, semiconductors, ESG, electric vehicles. Save those for after you have some experience. Second, what's the expense ratio? Look up the total expense ratio. The lower, the better. As a beginner, only consider ETFs below 0.5%. Some thematic ETFs charge 0.7 or 0.8%, be careful with those. Third, how big is the fund? As a beginner, pick ETFs with at least $5 billion in assets under management. Why? If a fund is too small, it can be liquidated and shut down, your money gets force redeemed, and you lose your timing. Fourth, what's the daily trading volume? Pick ETFs with strong daily volume, at least 100,000 shares per day. If the volume is too low, the bid-ask spread widens, and you end up paying an invisible fee on every trade. Run those 4 checks, and your shortlist gets really small. The 3 names I recommend for beginners, VTI, VOO, and VT. All 3 pass every indicator. Textbook entry choices. Remember one rule, broad market before thematic, low fee before high dividend. Keep that in your head, and you won't get lured by flashy thematic ETFs. Finally, let's walk through the actual mechanics. Buying your first ETF takes just 3 steps. Step 1, open a brokerage account. If you don't have one yet, pick a broker with low commissions and a friendly app. In the US, the common choices are Fidelity, Charles Schwab, and Vanguard. All 3 offer commission-free ETF trading and great recurring buy features. Most accounts can be opened entirely online. Have your driver's license and social security number ready, and you're done in about 30 minutes. Step 2, set up a recurring buy. Once your account is open, find the recurring investment feature in your broker app. Pick an ETF, VTI or VOO, and set the monthly amount. 2 tips here. 1, the amount doesn't have to be big. Most US brokers let you start at $1 with fractional shares. Beginners can start at $50 to $200 a month. 2, schedule the auto deposit for the day after payday. That way, money goes into the market the moment it lands, and the rest is your spending money. The order matters more than you think. Step 3, enable dividend reinvestment. This is the most overlooked but most impactful setting long-term. Inside your ETF holdings, find the option called DRIP, or dividend reinvestment, and turn it on. Or, just pick an accumulating ETF, these automatically reinvest dividends instead of paying them out. They usually have an N or ACC suffix in the name. Your jar quietly fills itself. Open the account, set up auto deposits, turn on reinvestment. 3 steps done, and your ETF investing machine runs on autopilot. From now until 30 years later, you only have one job: don't turn it off. Okay, that's a wrap on Lesson 5. Today you learned the 3 key features of an ETF, how it compares to individual stocks and mutual funds, the 5 reasons beginners should start with ETFs, why a 1.2% fee gap costs you $272,000 over 30 years, the 4 key indicators for picking an ETF, and the 3 steps to actually buy your first one. Before we wrap up, here are 3 small homework tasks you can do this week. First, pick one broad market ETF, VTI, VOO, or VT, and run it through the 4 indicators. Write the numbers down. Second, dig up the expense ratio of your current mutual funds, retirement plans, or savings products, and compare it to the ETF benchmark of 0.3%. Run a quick 30-year compounding math. The gap might keep you awake at night. Third, if you don't have a brokerage account yet, open one this week. Online setup takes about 30 minutes. If you don't open one, you literally cannot buy. Once you finish those 3 tasks, you're fully prepped for your first ETF purchase next month. Next lesson, we tackle a question many investors get stuck on. VTI versus VOO. Both are broad market ETFs, but the philosophies are completely different. Next time, with real numbers, I'll walk you through which one fits which life stage. If today's lesson helped, please subscribe and hit the bell so you don't miss it. See you in the next lesson.